This is Ralph Sass, and this is Accounting 211. And this is Chapter 4. This is the lecture to Chapter 4. This is Part 2, and we're doing adjusting entries, probably some of the most difficult of the journal entries for Accounting 211. And the third of our adjusting entries is accruing for unpaid expenses. The big ones, in my opinion, are wages and salaries and interest, but there's a whole host of other items that fall in this category as well. What happens in this particular category is, notice what's happening here. The transaction in the other cases was happening up front, in the other situations was happening up front. Now the transaction is going to happen in the future. So we're going to have an adjusting entry to recognize the expenses incurred and to record the liability. And then at some later point, okay, they're going to go ahead and pay us. Most of us don't get paid at the end of, and to give you an example of why this occurs, most of us don't get paid at the end of the day. And if you think about it, theoretically, at the end of every day, your boss owes you some money. Let's just assume it's $200 a day, okay? You worked a day, he owes you $200. If he doesn't pay you today, that means he has a liability at the end of the day because he owes you the $200 and he is going to pay you at some point in the future. You and I call that our payday, okay? And so he has a liability. And if we work tomorrow and he doesn't pay us tomorrow, there's another liability there for another $200. And so what happens is this is going to add up until such time as he pays us. Well, the same thing happens in business, okay? And so what happens is at the end of the period, at the end of the month or the end of the year, whatever, we're going to have to make this adjusting entry to reflect the fact we owe some people for work they performed in March and we haven't paid them yet, or April or May, whatever that month is. So take a look at this particular example. The company owes $1,950 in wage expense for working Monday and Tuesday. Tuesday is December 31st. It's the end of the year. If I put together a balance sheet right now and didn't reflect the fact that I in fact owed my employees, I would have understated my liabilities for wages by $1,950. So it's only fair I do an adjusting entry to reflect the fact that my employees worked Monday, Tuesday. I had revenue for Monday and Tuesday. Let's match those revenue with those expenses, in this case salaries, and let's reflect the fact that when our year ends on Tuesday, December 31st, in this case, I owe my employees $1,950 for the time they've worked. And when am I going to pay them? I'm going to pay them on January 3rd. So what happens in this particular case is at the end of the month, I do a wage expense. That's my income statement item. And I debit it. And a debit will mean that wages expenses is going up. Okay. And then I'm going to have a wages payable. And the wages payable is going to be my balance sheet item, and it's going to be a credit because I owe my employees. It's going to be a liability. And so what am I doing? I'm pushing up my liabilities. Okay, looking at my T accounts, it looks something like this. Once again, impacts both the income statement and the balance sheet. Now at the end of the week, I owe the employees another $447, okay, for a total of $2,397 for the week. Okay, so notice what happens at the end of the week when I pay them. There's my cash for $2,397. My wage expense for January is the $447. My wages payable is $1,950. That reflects the fact that those expenses were incurred, okay, back in December, and it fully reflects the fact now, and I'm going to have matched my December expenses with my December revenue and my January expenses with my January revenue. The last of our adjusting entries is accruing for uncollected liability. The big one, and both of these are big, work completed but not yet billed to customers. Okay, I did the work, but I'm not going to bill the customer perhaps until next month or next quarter or what have you, and interest earned. Okay, once again, notice what happens. There's nothing that occurred up back here in this prior period. It's all in this future period. Okay, so what I need to do is I need to make an adjustment entry that is going to recognize the revenue that I haven't yet put in my income statement, and record that I now have a receivable that'll be my balance sheet item. And then at some point in the future, when I actually collect the cash, that 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 journal entry will kind of work its way through. Watch what happens. Suppose I have a process where I send out my bills and people pay me on the 15th of the month. It's now December 31st. I've worked for this particular customer for 15 days. They owe me $750 for work I've done. But they're not going to pay me until out here in January. Well, if I put together a balance sheet on December 31st, it's only fair that it show A, that I earned this $750 in December. It's also only fair to show that those people that I did that work for owe me the money. So what I need to do is I need to make this adjusting entry on December 31st to reflect those realities. So notice what I'm going to do. On December 31st, I'm going to make an adjusting entry. I'm going to debit my accounts receivable, which is my balance sheet item, and that shows the fact that I've done the work and they owe me the money. And I'm going to credit a revenue account, in this case repair service revenue, which shows that, and that's my income statement item, which shows that I worked and earned $750 of revenue. Okay, so once again, I've got a balance sheet item and an income statement item. There's my balance sheet item, my accounts receivable. There's my service revenue, my income statement item. And notice, and I've got a typo here, okay, this should not be interest, okay, but it should be service revenue. But notice, there's my $750 in service revenue to take me to December 31st, and another $750 worth of service revenue to take me to January 15th. January 15th, I call them up, cut them a bill, and they pay it. Notice what happens. My cash goes up. How much does my cash go up by? The full amount for $1,500. And of that, repair service revenue for January is $750, the amount I earned during January. $750 is the amount that I already earned the month before, so that's my accounts receivable. And so that's going to be my credit as well. So I've got a debit to cash and a credit to a revenue account and a credit to the accounts receivable. Notice, even though I collected $1,500, ultimately I included all $1,500 as revenue. This $750 is the revenue from January. This $750 I counted as revenue last year in December. So I counted it all as revenue. It's just a matter of the timing of it. Another example where this occurs, where we need to make adjusting entries, is income tax. The government does require corporations to pay an income tax, and frequently almost always, they don't pay it at the end of the month. They pay it during the 30 to 60 days after the end of the quarter. So what that means is they have to create a journal entry to record the expense, and that's going to be my income statement item, okay, and to reflect the fact that I owe the government, and that will be my balance sheet item, okay. So I have income tax expense. Keep in mind, expenses are almost always debits, and in this case I've got income taxes payable, which is my balance sheet account. The whole purpose of all these adjusting entries is to match, okay, my revenue and my expenses, okay. And there's two ways to do it. One is to make a direct association of costs with the specific revenue. If I'm painting houses, okay, I know exactly how much paint I used on their walls. I can make a direct association between how much paint I used on their walls and what have you, and how much that costs per gallon, what have you, and there's a direct association there. But there are also times where I have to systematically allocate those costs over the useful life. The truck I used to drive to the house to paint, there's no way to allocate that. I can perhaps allocate, if I wanted to, the cost of the gas, service, what have you, but there's no way to allocate that $30,000 that I paid for that truck to that. So what I do in that case is do just a systematic allocation using depreciation. How do companies decide when they're going to make adjusting entries and what have you? One of the questions that comes up is it material? And what's material for one company may not be material for another, okay? Many companies, in fact most, immediately charge the cost of immaterial items to an expense. I spend $50 for a ream of paper or for a box of paper. I'm going to use it over the next 4 months. $50 is kind of a trivial expense. I've got to count it as an expense, but does it really make sense for me to put it on my balance sheet as an asset and then count the number of pages that I printed off during the month or find out how much is, and the answer is no. So there are a lot of things like supplies that I don't always keep track of in quite the same way as I do my bigger expenses just because they're immaterial. Usually my insurance policies and things like that are going to be material. For purposes of this class, a lot of times we're going to do adjusting entries just to get practice on the supplies and material, but in the real world, they're not going to be material, and we're just going to write them off as an expense when we pay the bill. This just summarizes what's going on with my adjusting entries when I make them, depending upon the 4 types of adjusting entries. And I guess my key point here is note that every item impacts both the income statement as well as the balance sheet. Okay. Notice all of the items in red. All of the items in red, okay, are going to be items, and I'm just checking here to make sure, are going to be items that are impacted by my adjusting entries. Okay, notice buildings, lands, note payable, those are not going to be adjusted. Cash is never, ever, ever an adjusting entry. Okay, so if you ever put cash down, it's not an adjusting entry. You're doing something either wrong or you're not doing an adjusting entry. Okay, so for the most part, most of our balance sheet is subject to adjusting entries. Cash is not, capital stock is not, retained earnings generally is not, dividends is not an adjusting entry. We'll find out what to do with that in the next chapter, chapter 5. Advertising expense and utilities expense, they could have been adjusting entries, just didn't work out in this particular case. Notice, and we started with this last time, we've learned to journalize transactions back in chapters 2 and 3, and we posted them in chapters 2 and 3. We prepared a trial balance in chapter 3. Now we've seen there are 4 types of adjusting entries, and we've made those adjusting entries. We do need to post them. I mean, if you want to argue that the book is missing the fact that I've got to post those adjusting entries after I've made them in my general journal. Keep in mind, most software programs automatically do that. And then after I do that, what I need to do is prepare my adjusted trial balance. That concludes the lecture for Chapter 4. If you have any questions, please feel free to let me know.